Good afternoon, traders. Scott Norris here with your Forex report. Today is Friday, November 3rd, 2006. The dollar ran into serious trouble early this week, but was saved today by a very optimistic employment report. Coming off a very bearish move last week, the dollar spent most of Monday consolidating. Last Friday's disappointing GDP had been digested, and Monday's data was slightly more supportive. Tuesday was not so calm, however, as traders sold the dollar aggressively on the back of falling consumer confidence in a big slip in Chicago PMI. This move brought the greenback near 2006 lows against some currencies and left the U.S. dollar index on the verge of a reversal. Wednesday morning reports were mixed and threw many traders for a loop. The first round of data was dollar positive, but the market hardly responded. Nearly 2 hours later, disappointing ISM data sent the dollar down sharply, but only for a matter of 15 minutes. After testing Tuesday's lows, the buck staged an impressive comeback and even tried to rally. This led to more consolidation in the broad market on Thursday as we headed into today's big employment report. The Labor Department threw dollar bulls a big bone today, making a revision to last month's payrolls that nearly tripled the original number. Furthermore, the unemployment rate dropped by 0.2% in October to 4.4%, a new 5-year low. The greenback did fall in the first 5 seconds after the report, as traders saw only 92,000 jobs on the month. However, once eyes turned to the revision and the unemployment rate, the U.S. currency rallied back sharply. The rally was stopped short by major technical resistance, but closing prices will still be at respectable levels. We believe this leaves the door open to dollar strength or weakness early next week. Now to the big picture. Yields are still the primary fundamental force in this market, evident in the independence seen in the majors. Currencies backed by high interest rates continue to outperform those backed by lower rates to a great degree. The ECB met this week and confirmed that rates would likely go up next month, but this has already been priced into the euro. Meanwhile, the Bank of England and the Reserve Bank of Australia meetings next week are both expected to conclude with 25 basis point rate hikes. This will further underpin the pound sterling and Aussie, which already carry favorable rates. While almost all hopes of further rate hikes from the Fed have disappeared, so too have many bets on a rate cut early next year. Fed funds futures now indicate no chance of a rate cut before March and only a 17% chance then. This is down from almost 100% chance early this morning. This, of course, bodes well for the dollar in the short term, but the bigger picture is still very murky. We see room for dollar strength or weakness through the end of this year, given the strength of today's report. The major moving averages will remain a strong guiding light for the overall dollar direction. Until we can get a firm grasp of just how soft or hard the U.S. economy will land, volatile trading conditions may persist in the months ahead. Until next week, have a wonderful weekend and take care.